Many stocks often show a classic reversal pattern before a sharp decline, bearish engulfing. If you can identify this signal early, many high-level risks can be avoided in advance. So, what is bearish engulfing? It also consists of two candlesticks. On the first day, there is a bullish green candle, indicating the stock price is still rising. But on the second day, a large bearish red candle suddenly appears. And the body of this bearish candle completely engulfs the body of the previous day's bullish candle. It is as if the previous day's gains have been entirely swallowed up. This is called the bearish engulfing pattern. What does this pattern mean? It means that market momentum is changing. Originally, the bulls were in control, but on the second day, the bears suddenly take control. They not only erase the gains, but also fully cover the previous day's upward range. This often means upward momentum is weakening and the market may enter a correction. However, there is one key condition. Bearish engulfing works best when it appears at the high of an uptrend. Only then does its reversal signal become stronger. Let's use a real example to explain. After a stock had been rising continuously at a relatively high level, it first formed a bullish candle, and market sentiment was still bullish. But the next day, the price surged higher, then pulled back, closing with a clear large bearish candle, whose body completely covered the previous day's bullish candle. This is a typical bearish engulfing pattern. The appearance of this pattern often signals a market top. Afterwards, the stock price entered a significant correction. But you must remember, bearish engulfing is not an absolute sell signal. Truly professional traders usually judge based on three combined conditions. First, check the location, whether it appears at the high of an uptrend. Second, check trading volume. If the bearish candle has heavy volume, the signal is stronger. Third, check the follow-through trend, whether the price continues to fall for confirmation. Finally, here's a simple formula for you. Engulfing at the high, watch for a pullback. Engulfing at the low, it may just be a washout. Candlestick patterns are actually reflections of market sentiment. Once you learn to read these signals, many risks are already written on the charts before the decline even starts. That's all for today's sharing. This knowledge is essential for every trader. I'm Young Jay. See you next time.